For another episode of Canadian Mortgage Weekly, live here from my studio office. So, what are we talking about today? The Bank of Canada raises rates 0.25% yesterday on June 7th, 2023. Where is this going to go? How is this going to affect interest rates going forward, the market? And what's the market really saying today? Well, how's the market reacting to this news? I'd love to talk about this with you, as well as some mortgage data that I'm going to go over a little bit later in my episode today. For those of you joining me today, we're streaming live across TikTok, Facebook, YouTube, LinkedIn. So glad you could join us today. What we're going to start off with first is the obvious elephant in the room, and that is that the Bank of Canada raised rates 25 basis points yesterday. So how is that going to affect everyone in Canada? Well, let me go over that with you here. First of all, variable rate mortgage holders. Any one of you has a variable rate mortgage right now in Canada, your mortgage is going to be affected by this Bank of Canada rate increase. Really, there's no stopping that. And because of that, how is your mortgage going to be affected? Well, for most variable rate mortgage holders, I know that most for variable rate mortgage holders, they are on a fluctuating payment. So where the payment actually doesn't stay static for the term of your mortgage, it can actually go up and down compared to where rates are at. So if you have a variable rate mortgage today, you'll probably either receive a notification from your bank or mortgagor uh, with your variable rate mortgage that your prime rate has gone up. And because prime rate has gone up, your payment will change. And because your payment will change, you'll send you a notification via mail or perhaps via email if you're signed up for those, or even like a phone notification that your payments are changing going forward. Your payments could change. And if you have a variable rate mortgage where payments don't change but are static and it's the amortization that changes, then separate thing will happen. You will receive a notice saying that your amortization has been extended. So for those of you who have variable rate mortgages where the amortization fluctuates, I've seen during this rate hike cycle where the Bank of Canada has been raising interest rates, that they've been actually increasing, the lenders have been increasing the amortization. So say if you had a 30-year mortgage, then from the first rate hike, you would have gone up to say 34 years, then 38 years, then 42 years, 47 years. I've seen that some clients now have amortization schedules reaching close to 30, between 30 to 50 years now because of these rate hikes, where there's so much of your payment now going to interest that it's really difficult to actually pay off a balance. So if you have a variable rate mortgage, then a lot of folks, what they've been doing is what variable rate mortgage holders have been doing is contacting their lender to see if they can lock in. So when people lock in, what they do is they actually take a fixed rate for the remaining amount of their mortgage term. So, say if you had a 5-year variable and you're 2 years in, meaning you have 3 years left on your term, then what you can do is actually lock in for the remaining 3 years at a 3-year fixed. Because so many people have been doing that, actually, the banks have raised their 3-year fixed rates accordingly, because obviously they want to make their money. And with that, I'm seeing a lot of folks take on these 3-year fixed mortgages, and that seems to work for a lot of folks because they are locking in for the remaining years that they believe the rates will remain high for, and then they'll come back down. So let's talk about that briefly before we cover off. And we'll come back to that when rates will come down a little bit later in the episode. But that's what happens if you have a variable rate mortgage. Either your payments will go up or your amortization will go up. And another thing that's going to happen is anyone who has a vehicle loan. I know there's vehicle loans that can be on a fixed rate, and there's vehicle loans that can be on a variable rate. I had a vehicle loan on a variable rate once before, and obviously the draw to that was the slightly lower interest rate. Now, what happens when the rates go up on a variable rate vehicle loan? Car, truck, doesn't matter. Well, what happens is your amortization most likely gets extended. So, say if you had 7 years remaining on that vehicle loan, it's now going to go up to, say, 8 years, 9 years, 10 years, depending on how much the rate has gone up. If you're on a vehicle loan, though, where the payment fluctuates, then your payment will change. It will either go up $20 biweekly or $30 biweekly, whatever it is, and based on how much of your vehicle loan you have left. So if you have a vehicle loan, it's definitely something that you should look at if you have a variable rate interest rate. So vehicle loans, mortgages, we covered those two. What else is going to be impacted by the Bank of Canada rate increase here that we saw yesterday of 0.25% in Canada on June 7th, 2023? Well, we also are going to see home equity lines of credit be affected quite considerably. If you're carrying a balance on a home equity line of credit today, say whether it's 10,000, 100,000, 50,000, you're going to see your monthly minimum payment increase on your next available statement. And they're going to send you a notification on that statement saying that prime rate was this, now it is this. And because of that, they're going to charge you a higher minimum payment. And those minimum payments, mind you, they are not paying off any principal. So that higher minimum payment is 1,000% interest. And when I say 1,000%, I don't mean to over exaggerate, 100% interest. It's just right now, I'm seeing a lot of my clients call me and ask me, you know what, Joe, I know you got 13 years experience in the industry. What should we do with our home equity lines of credit? It used to be that it was a better idea to keep it in a home equity line of credit, but now I'm seeing that I need to figure something out because I'm never going to pay this thing off. Well, if that's you, definitely invite you to reach out to me via private message, text, whatever it is. Just click on my profile link and you can see my information there. What else is going to be affected other than home equity lines of credit? Those are tied to your mortgage. Well, unsecured lines of credit will be affected as well. Those are based off of a prime rate. And because prime rate did change yesterday, unsecured lines of credit will see their minimum payments go up as well. So unfortunate, right? But for Canadians that are carrying a balance on these lines of credit and home equity lines of credit, those rates will go up and your minimum payment will go up. So if you have an unsecured line of credit, I invite you to possibly look at consolidating that because those rates tend to be higher than mortgage rates, higher than home equity lines of credit as well. They tend to be almost, or now with the rate increase, in the double digits, 9, 10, 11%. There's other items that will be affected as well. If you have a credit card with a variable interest rate, most credit cards in Canada are fixed. They do usually have a fixed interest rate around 19.99% or 20.99%. However, for credit cards, there are some that have a variable rate. And with those variable rate interest rate credit cards, you'll see your minimum payment increase and perhaps the amount of interest charged on your variable rate credit card will change and go up as well. So anyone with a variable rate credit card, you're still going to be ahead of the game versus a fixed rate credit card. However, be aware that the credit card interest rate changing will cause your minimum payment to change as well. If you're just joining me here now on TikTok, LinkedIn, Twitter, Facebook, or YouTube, we're talking about the Bank of Canada interest rate increase and how that 25 basis points is going to affect Canadians across Canada and how we're going to see changes forward for anyone with a variable rate mortgage, home equity line of credit, an unsecured line of credit, a variable rate car loan, or a variable rate credit card. So those are the main items there. Now, conversely, if you're a saver, because the interest rates have gone up, your amount of savings interest will go up as well. Not as much as the lending side. However, if you do have money in GICs or other sort of savings account interest rates, high interest savings accounts, you'll see those savings rates start to increase. So if you're a saver, it's a great time to be a saver. you're going to be in a great position to earn interest on your savings at a higher rate. So, great time to be a saver and not a great time to be a borrower with a variable rate loan product. So, those are some of the ways that the Bank of Canada interest rate increase yesterday on June 7th, 2023 are going to affect uh, mortgage holders, variable rate credit card holders, variable rate car loan holders, as well as unsecured line of credit holders and home equity line of credit holders. You'll see some changes to your accounts, whereas those with fixed rates have those mortgages or loan products locked in. Anyone with a fixed rate mortgage will not see any change from the Bank of Canada interest rate change yesterday. So, what else is going to happen here as we look forward into 2023 and rates? Well, how else are the rates going to affect Canadians? I think another way that interest rates going up yesterday are going to affect Canadians are qualifying. Because the prime rate has gone up in Canada, we're going to see a lot of folks have a more difficult time qualifying for loan and mortgage products. Not that it hasn't been difficult enough already with these rates going up at the speed they have. However, we will see it'd be harder to qualify. And when I work with buyers right now, especially first-time buyers, I'm talking with folks that have, each of them have an income, they have little debt, and they're still not able to qualify for a home in Canada on their own. You know, uh, the husband say makes 60,000 a year, the wife makes 60,000 a year, together they make 120,000. They're still not able to afford a average price home in Canada, even with no debt. A lot of the times these days, I'm seeing folks need to have a co-signer just to afford a home in their market. I'm located in Ontario, Canada, and Ontario, Canada has some of the higher priced homes across Canada. Also, the average price home in Canada nationally is currently sitting at $716,083. That's the average home in Canada, not the high end. That's the average home. I know 10 years ago, that would have been the high end home selling for $716,000. Now that's the average home. What do you guys think about that? Do you think that's sustainable with rates changing the way they have? I don't know if it's going to affect the housing market going forward, but we've been seeing a little bit of a housing market rebound in Canada the last 3 months. I mean, last month in April, the last month we have statistics for, we saw the average national house price change month over month by an increase of 4%. The month prior, we saw an increase as well of 4%. And the month prior, 3 months ago, we saw an increase of 8%. So we've been seeing increases in house prices since the beginning of the year, and that correlates to around the time when the Bank of Canada paused its interest rate hike cycle. They said we're going to pause rate hikes for the time being because they thought that they had inflation under more of a they thought they had more of a handle on the inflation rate in Canada. However, inflation rate going up last month by 0.1% really threw things off the rails for the Bank of Canada and what they're expecting to happen for inflation going forward. Now, how is inflation going to be affected by this rate hike that we saw yesterday? Well, when I look at the inflation graph here, I'm seeing that when inflation did hit its peak last year, June of 2022, we saw inflation in Canada hit a peak of, let's see where it was. Was that, where's the thing here? 8.3%. Can't see my screen, got my phone in the way. And since then, the Bank of Canada has been raising interest rates to combat that. And since they started raising interest rates, I have seen inflation start to fall. Mind you, it's still very high. Inflation is so high in Canada right now. We're still seeing prices go up, but it's slowed the amount of increases that we're seeing each month down. And it's just not enough. We're still seeing inflation rise as of April of 2023. It went from 4.3 to 4.4. So they're going to have to keep raising rates, I think, until they get that under control. We'll see what the most recent rate hike will do. Right now, we have prime rate much higher than inflation. Prime rate's currently sitting at 6.95%. Can you believe that? If you're a triple A credit borrower and you want prime rate, then you're going to get 6.95% as your prime rate today in Canada. Looking back, prime rate was much lower just 2 years ago, much lower. Variable rate mortgage was the way to go 2 years ago. Now, not too sure. Variable rates have been great for Canadians because they offer flexibility. You can break that mortgage with the lowest penalty of any mortgage out there. And with variable rates, you also have a lot of flexibility. You can lock in anytime without any penalty. And they offer flexibility in terms of if rates go down, you can actually win the market with a lower interest and lower payment than the competing fixed rate. However, now, if you've been locking in these last few years, you've been winning because the variable rate is just so much higher. And prime at 6.95% is just way higher than any fixed rate that I've been seeing from any AAA lender. So, with that, if you're just joining me here today, I'm talking about how this rate increase is going to affect Canadians. What we've done is we've gone over variable rate mortgages, saying that either your payment will go up or your amortization length of time to pay off the mortgage will go up. We've also been talking about home equity lines of credit, how their minimum payments will also start to go up starting next month, as well as those who have variable rate vehicle loans, variable rate credit cards, and variable rate unsecured line of credits. And most unsecured line of credits are by default a variable rate. And we're talking about the housing market. It's been increasing and rebounding in Canada at the start of 2023. And I don't know. I think this may put this might extinguish that. This rate hike may actually put a lot of buyers and those who are refinancing on the sidelines, probably for a few months right now, as they wait out to see what's going to happen in the Canadian housing market. The next Bank of Canada rate increase, not increase, announcement will be on July 12th. I don't want to prophetically say anything here, not that I know, but July 12th, 2023 is the next rate announcement in Canada, and we're expected to see possibly another rate increase if inflation numbers don't come into check by then. We are still waiting for May inflation numbers. Usually we do receive inflation numbers for May around June 15th, maybe earlier. And the Bank of Canada will be watching those May numbers. And with July 12th being the next announcement, that will actually be before we see the June figures. And the June figures are the figures that are going to be the most impactful, because we only saw the rate increase on June 7th. And the Bank of Canada will not be able to really see the impact of the rate increase until the announcement following June 12th. So it remains to be seen whether or not they will remain on pause or on alert for the July 12th announcement. I have a feeling we may see an additional rate hike on July the 12th, just as they figure out where inflation is going, and then with that, make a separate announcement for the following one, seeing the June figures come in for inflation. At that time, perhaps June figures will show lower inflation with the 2 rate hikes that will have gone through by then. So if you're just joining me here now, my name is Joe Bladek. This is episode 142. I do these weekly where I go live and just talk about how mortgages are being impacted in Canada, some mortgage advice, and we go over the market. Today, we're specifically covering the market and the rate announcement yesterday in Canada is big news because we did have that rate hike paused by the Bank of Canada since March, and it's been really helping rebound that housing market in Canada with a 4% increase in April, a 4% increase in March as well. It's really good news for anyone who owns a home, but this may actually extinguish that. So, looking at fixed rates, though, what affects fixed rates? Well, it's the 5-year bond yield. 5-year Canadian bond yield, if you Google that, you will find it's sitting around 3.66% today. And the 5-year Canadian bond yield is where banks go to determine where to price their fixed rate mortgages. If you look at the graph of the bond yield, you'll see that it was about 100 basis points lower in just earlier this year, touched that point in March, and it touched it in May. And during that time, I did see fixed rates come down, where we saw fixed rates in the low fours for a little while there, a 5-year fixed rate. And those of you who were able to get pre-approved during that time, were able to lock in rates at that lower fixed rate, which is really good. However, now, with it being 100 basis points higher, usually the banks correlate their fixed rates comparatively to the bond yield. So with it being 100 basis points higher, I can expect now that rates will start to climb on the fixed rate side. So the lowest 5-year fix will no longer be in the low fours, but be in the low fives. Now, these are mortgage rates I really haven't seen since I bought my first home in 2003. So, I mean, that was 20 years ago now. And I remember buying my first home and I got a rate, I think it was 5.9%. And that was with a cosigner. And that was with AAA credit. So that was a pretty decent rate. I remember thinking that I got a pretty good deal on that rate. And that was a pretty decent rate back in 2003. So we're looking at rates close to 20 years ago now. And with that, I know house prices were a heck of a lot lower 20 years ago. So will house prices come down now? Not quite sure. Not quite sure where we're headed with house prices because there's another impactful thing that's happening in Canada that is keeping home prices where they are at. Actually, there's 2 items I want to share with you today that are keeping things where they are at for home prices. Those 2 things are immigration, number 1, and the second thing will be housing starts. So why do you think that's the case? Well, I think immigration is at its highest it's ever been. We have so many Canadians entering Canada every year right now, about 500,000 Canadians every year. So where are they going? Well, from what I'm seeing, these Canadians are able to buy homes really easily in Canada because number 1, they're coming with money from their home country. They already have savings. They're moving to Canada with funds. Number 2, they have work experience. And in Canada, because the job market is so strong, they're able to get jobs pretty quickly. And it's the whole family that's coming over. So when we see that whole family coming over, they all get jobs. And in Canada, there's a special program called the New to Canada program. And if you're new to Canada, immigrated within the last 5 years, then you're able to buy a home only with 3 months work history in Canada. 3 months, whereas a typical Canadian usually needs about 2 years work history before they can qualify to buy a home on their own. So 3-month work history, if you have 0 credit score in Canada, then usually an exception is made on that as well through this New to Canada program. And we can just, use alternative sources of credit, whether it is bank records from their home country or a credit score from their home country, or even, say, a reference letter from a banking institution from their home country. There's many different things we can do to alleviate that credit burden for folks to buy a home. And what they're doing is they're all going on an application together, mother, father, son, daughter, the four of them. So when you have four incomes on one application, they have no issue affording the average national Canadian home. It's those folks that have the two incomes now that are struggling to buy a home in Canada, because the four income full family going on the mortgage is beating out the mom and dad trying to buy a home. So it's almost like these days you need to have mom, dad, son, and daughter working to be able to afford a mortgage on an average national price home in Canada. That's just the average home. Can't believe that. When I was buying my first home, it was just me and a cosigner. That's it. So those are some items that are affecting that are all happening in the market right now. If you have any comments, I'd love to see what you guys think. The house prices will go, where interest rates will go. But as far as interest rates, from what I'm hearing, originally we were supposed to see a rate reduction early 2024 or possibly end of 2023. Do I think this is going to happen any longer? Unfortunately, no. We will not see a rate decrease in late 2023, and I don't think we'll see a rate decrease in early 2024. The new thing I'm seeing is either A, rates may decrease, and that will be end of 2024 now. Because of inflation going up recently, this whole schedule we've had in our minds, the whole optimism that we've had in our minds is out the window. Either end of 2024 rates will go back down, or these are the lowest rates we will see for a while. And there are some experts now saying that. And that's really unfortunate, because if these are the lowest rates we will see for a while, then what does that mean for the housing market? Well, if I don't want to give advice, but if these are the lowest rates we'll see for a while, it's going to really be hard for folks that are renewing, because when you get your renewal letter, your renewal will start to jump quite considerably. And if your renewal starts to jump and your payments start to jump, I'm already seeing that. I'm already seeing people with their mortgages come to me saying, you know what, Joe, I was paying $3,000 a month. Now I'm paying $5,000 a month on my renewal. What can I do? Well, because of that, we may start seeing homeowners throw in the towel and sell their home because they can no longer afford that home. And if they can no longer afford that home, who's going to buy that home? Well, I can tell you 100%, it's those immigrants that are coming to Canada. They're all getting jobs and they're all going on title together, all four of them, or even all six of them, with the grandpa and grandpa working as well. So immigration, I think, is keeping house prices where they are at. Another thing I mentioned that is keeping house prices where they are at is housing starts. And why is housing starts keeping things and prices where they are at in Canada? Well, housing starts have been on the decline year over year over year over year. If you look at the long term, they may have gone up a little bit here and there, but on the long term, it's going down over the last 20, 30 years, which means that Canada has not been building enough homes to keep up with the demand that we currently have. And that demand's coming from, babies obviously being made in Canada and families immigrating to Canada, 500,000 people a year. And with 500,000 people a year coming to Canada, they have to live somewhere. And it's those housing starts being at ultimate lows right now that are really hindering the creation of new housing units. And when you hinder the creation of new housing units, you're just left with that deficit. So there seems to be a deficit in Canada of housing units. And because there's a deficit of housing units, there's just not enough homes to go around. And because there's not enough homes to go around, that's also keeping prices high on those homes. So with house prices being where they are at, I don't think they will go down anytime soon because of interest rates. I think they will start to go down if immigration and housing starts change, as well as interest rates remain high. And so long as immigration stays high at 500,000 people a year, and housing starts remain low, then that will help keep the housing market where we're at. It's these lower rates that really fueled it and really put a fire under it. And everyone seemed to be buying a home with the lower rates. All right. So looking at the interbank rate, why do I look at the interbank rate? Well, the interbank rate is Canada's 3-month interbank rate, and that's where banks get their funds to fund variable rate mortgages. This has been on a steady increase since the early 2022 start of the year. We saw it hit 5.04% in January, and it kind of hovered there for the last 5-6 months. And we didn't see a increase of any sort until just yesterday, where it bumped up to 5.23%. What does this tell me? It tells me that variable rates are not very competitive, because you want to have a variance to prime of under 2%. With prime currently being at 6.95% and the interbank CDOR rate being at 5.23%, that's a less than 2% variance, and that makes the variable rate not competitive to the fixed rate. Anyway, where do I think this will go from now? Well, the Bank of Canada really wants to slow the economy down. There's no doubt about that. Their main aim right now is to slow down the economy. What does that mean to folks that have jobs? Well, actually means that the Bank of Canada wants less jobs being created, so much so that they probably would want to see layoffs and companies downsizing right now to be able to slow the economy down. It's when those folks that had jobs go unemployed, and when there's such high unemployment, that can really bring down inflation as well, because people can't buy anything. They don't have an income anymore. And when people can't buy anything and don't have an income and are contributing to the economy the same way any longer, then the economy starts to slow. And unfortunately, that's what the Bank of Canada is raising rates for. They need the economy to slow down, and they won't stop until that happens. And that may sound really morbid, really negative, actually. And if you think that sounds negative, it's because it is. They think that the rates need to keep going up until the economy starts to slow, and they won't stop until that happens. And what do I see with the job market? The job market added 41,000 jobs last month. That's a lot of jobs in Canada. We'll see May data in just a few more days, and we'll see what happened in May. But because the rate announcement didn't happen until June, I'm thinking that there were even more jobs added in May, which is just going to further the whole Canadian economy and help everyone to contribute to the economy, so the economy does continue to grow. And with the economy growing under a higher interest rate environment, it's going to be really hard to afford these borrowed mortgages, borrowed lines of credit, borrowed home equity lines of credit, all that. As mentioned, house prices have been going up for the last 3 months. Who knows? Maybe there will be a little bit of a flatlining now that the rates have gone up 25 basis points yesterday, with certain folks not being able to qualify for that home and certain folks that will, because they'll be okay with putting 4 or 5 people on that mortgage. That's the only way we can get a mortgage in Canada for an average priced home, is if 4 or 5 people go on that mortgage these days. It's happening quite often. As a mortgage broker, I've been in the business now 13 years. When I first started, it was really easy for one person to buy a home with a good salary. Really easy. If you had $100,000 that you were making a year, you could buy a home on your own. Even $60,000, it was pretty decently able to buy a home on your own. Now, because rates have gone up so much, you need at least $150,000 or more to buy the average price home in Canada for your average family income. So with that, I'm going to just finish off by saying thanks for watching. Appreciate you guys joining in on this episode. I know we've talked about a lot of things today. We've talked about the inflation rate in Canada. It's going back up as of April. We've been talking about the American inflation rate. It hasn't started going back up yet, but we'll have to see what happens in May, because it really slowed the slowing of the inflation really slowed down in the United States. And with that, I have a phone call coming. I'm just going to cancel that. All right, there we go. And with inflation not really moving, we'll have to see what happens in the next couple days when May numbers come out for inflation. And when May numbers come out for inflation, I hope that the Bank of Canada sees that, as I'm sure they'll know, but it won't be impacted from this June 7th rate hike. It's only the June numbers that will be impacted from this rate hike. So we'll have to see what happens there. If you need any advice on your mortgage or some personal attention to your mortgage, I'm a mortgage broker working across Ontario. I am so happy to help you with your mortgage. Feel free to reach out to me via private message, phone call, text. A lot of people, what they do is they do text me after my podcast to talk to me about their mortgage. We usually set up a time when we can meet over Zoom, phone call, or whatever you like there. Thanks for watching today. Appreciate you. And plus, press that follow button. Follow my account. We'll love to be able to help you with your mortgage with some news. I release videos usually once a week on the podcast, and I release a smaller video, 1 minute in length, every day of the week. Little small mortgage tips to help you with your mortgage. Thanks for watching today. My name is Joe Bladdock for Canadian Mortgage Weekly, Canada's only weekly video mortgage news podcast. And we'll see you all next time.